Good morning, Mom. Good morning, classmates. So today we're going talking about uncollectible accounts. So when you see uncollectible accounts, is receivable loans or debt that have virtually no chance of being paid. So sa madaling salita, utang na hindi nababayaran o hindi binayaran. So direct write-off bad accounts. Direct write-off bad accounts is customer will not pay their accounts. There are two fundamental methods for handling this uncollectible accounts. So first is direct write-off method. Direct write-off method is recognize bad accounts as an expenses at the point when judged to be uncollectible, and also is the required method for federal income tax purposes. So, the required of method is gamiton na siya for income tax reporting. And the second is the allowance method. So, when you say allowance method, it's compared better to the accrual basis of according by matching bad debts expenses to revenue and is the accepted method to record uncollectible accounts for financial accounting purposes. So, when you see allowance method is used for general purposes reporting, gamiton na siya of general reporting. So, when you say accrual basis is recognized business revenue and matching expenses when they are generated, not when money actually change hands. So, allowance method, this means that a company record revenue when it is earned, not when the company collects the money. And writing of bad accounts. When its collectability is certain is called direct write-off method. So, tawagon siya direct write-off method and means the writing is uncollectability. And the next is the estimating bad debts expenses. So, when you say estimating bad expenses, the easiest but the less accurate way to do this to simplify, take a percentage of sale based on historical average and use it as estimating and periodically make sure it is fairly accurate over time. So accurate measurement uh, means the exact. So, the formula estimate bad debts expenses is bad debts expenses equals net sales, total or credit times percentage estimated use and collectability. Bad debts expenses kay utang sa customer pero dili siya bitaw makolek kay possible nga ang customer na bankrupt or something na kuan sa financial. Example is gitawag nimo for the last time. Unya ni answer sila or siya nga dili madayon, so i-entry dayon nimo. That is the estimating. So estimating uncollectability is percentage method estimating uncollectible accounts. So account receivable gross times estimated uncollectible equals allowance. Percentage of receivable method estimates uncollectible accounts by determining the desired size of allowance for uncollectible accounts. Example, if a company have a $1,000 in account receivable at the end of the accounting period, and company record indicate that on average 59 of total account receivable become uncollectible. That is the example. There are also three ways of estimating uncollectible accounts. First is by setting up a certain percent of uncollectible accounts based on the outstanding receivable. And the second is by aging the accounts receivable. And the last is by setting up a certain percent of uncollectible accounts based on credit sales. So that's the three ways of estimating uncollectible accounts. So, aging of accounts receivable. When you say aging account receivable is the most reasonable basis of calculating uncollectible accounts expenses based on classified past due accounts. So the account receivable factoring, also known as factoring, is a financial transaction in which a company sells its account receivable to financing company that is specialized in buying receivable at this discount. Account receivable factoring is also known as invoice factoring or account receivable financing. When you say invoice factoring, is a way for a business to fund cash flow by selling their invoices to a third party. Best uses when a business need cash to fund inventory purchase or payroll factoring account receivables. The buyer called factor. So, ang buyer is gitawag siyang factor. So, factor collects payment in the receivable from the company's customer. Then, company choose a factoring if they want to receive cash quickly rather than waiting for the duration of the credit terms. Factoring also allows company to immediately build up their cash flow and pay any outstanding obligation. Factoring helps companies free up capital tied up in accounts receivable and may also transfer the default risk associated with the receivable to the factor. Factoring account receivable is factoring companies change what is known as factoring fee. So, gitawag siyang factoring fee. So, when you see factoring fee is a percentage of the amount of receivables being factored. The rate changed by the factoring companies depends on things like the industry the company is in and the volume of the receivable to the factored and also the quality and credit worthiness of the company customer. Um, Factoring fees are the discount factoring companies receive for a purchasing invoices before they are due and waiting for a debtors to pay them. Factoring account receivable lets company access cash by selling invoices for cash advances. Example, if you sell a $100,000 worth of account receivable and get a 90% advance, you will receive $90,000. And that's all my topic.